To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
So friends, let's now have a look at the format given by the Companies Act for preparation of financial statements when companies are required to comply with Ind AS. So basically we are saying what is the format to be followed while preparing Ind AS financial statements. Now I have shown you an actual annual report where we understood what is the order in which items are placed, and then we also had references to the disclosures, the notes to accounts, and we also kept on referring to specific item on financial statements. This is more about a specific discussion with respect to Division 2 of Schedule 3 to the Companies Act 2013. So this is also given in Schedule 3 only. Division 1 is also in Schedule 3, that is for other companies. Division 2 of Schedule 3 is required for those companies whose financial statements are drawn up in compliance with companies' Indian accounting standard rules. So whenever a company has to comply with Ind AS, they have to prepare the financial statements as per Division 2 of Schedule 3, right? Some specific things to keep in mind. One is, if the compliance with the requirements of the Act including Ind AS, so what they are saying, while complying with the Act including the Indian accounting standards as applicable to the companies require any change in treatment or disclosure including additions, amendment, substitution or deletion in the head or subhead or any changes in the financial statements or statements forming part thereof, the same shall be made and the requirement under this schedule shall stand modified accordingly. So what does this mean? This basically means that if the Act says a different treatment, gives a different treatment, or for compliance with Ind AS you have to present it separately, or there are some additional disclosure requirements, then while complying with the Act and Ind AS, you will follow what is given in the Act and what is given in the Ind AS rather than sticking to this Schedule 3 format. So to that extent, the Schedule 3 format will stand modified automatically, right? So if there is a different kind of treatment that you need under a specific Ind AS or under the Act, then you will follow the provisions given under Ind AS and given under the Act and not under this particular schedule. Then the disclosure in this schedule are in addition to and not in substitution of disclosure requirements specified in the Indian accounting standard. So whatever Ind AS says that you have to disclose, apart from that, if there are any additional disclosures to be made under this schedule, you have to make those disclosures. And where will we make the disclosures? We will make the disclosures in the notes or by way of additional statement or statements unless required to be disclosed on the face of financial statements. So basically, disclosures you will give it in the notes. If there are additional disclosures by Ind AS, that also you will give it in the notes. Then it also says notes shall contain information in addition to that presented in the financial statements and provide narrative description or disaggregation of items recognized in those statements. So if you are looking at P&L or if you are looking at the balance sheet statement of financial if you are looking at the P&L or if you are looking at the balance sheet, for example, you have an item property, plant and equipment. Now here you will present a single amount. Now disaggregation means the breakup of this amount, you will provide it in the notes, and this we have done. We have seen it when we did property, plant and equipment, we did leases and all of that. We saw how the breakup has to be given. Then if there is any information about items that do not qualify for recognition in the statements, that also should be disclosed in notes. This is something like maybe a contingent liability which you do not recognize in financial statement, that you will display it separately or you will show it separately. Then each item on the face of the balance sheet, statement of changes in equity and statement of profit and loss shall be cross-referenced to any related information in the notes. So we see, right, note number 1, note number 2, note number 3, like this, notes have to be given, and in the respective note, you have to give the explanation about those items. This we have already seen in the annual report, what we have referred to in the classes. Then there is a requirement for rounding off. So depending on the total income, what is the total income of the company? Based on that, the figures appearing in the financial statement shall be rounded off. Now this is one very weird kind of requirement if you ask me, because in some cases when you have to round it off, now round it off to hundreds result in very weird way of presentation, right? But still they have done it and it has to be followed. So if the total income is less than 100 crore rupees, you will round it off to the nearest hundreds or thousands or lakhs or millions or decimals thereof. So you will have to round it off. Round off meaning what? For example, it is 999. You will present it as 1000. So while preparing financial statement, on the top you would write rupees in 1000, and below that you will write 1. So it has to be in the nearest hundreds, thousands, lakhs, millions or decimals thereof. So nearest hundreds, rounded off to either 100 or thousands. Thousands and lakhs and millions are generally followed, or decimals thereof. Okay. Then if the total income of the company is 100 crore rupees or more, so if it is less than 100 crore, then it will be 100,000, lakh, million and decimals. Otherwise, if it is greater than 100 crore, it will be nearest lakhs. So hundreds and thousands are not required. Lakhs, millions or crores or decimals thereof, right? Also very weird way to present in rupee million, because it is not intuitive. Dollar in million is more intuitive, rupee in million is not intuitive, but some companies do present, and we have to be with that. So if it is less than 100, then you can round it off to hundreds or thousands or lakhs or millions or decimals thereof, and if it is 100 rupees or more, you will have to round it off to the nearest lakhs, millions and crores. So this is second part, is greater than or equal to 100. Then financial statement shall contain the corresponding amounts comparatives. So comparatives means what? The previous period figures for comparison purpose that would be given, and for which period? For immediately preceding reporting period for all items shown in the financial statement, including notes, except in case of first financial statement. So in first financial statement, of course, you will not have preceding figures, but otherwise you will have corresponding amounts, and in some cases you may have 3 balance sheet, the opening balance sheet where respective standard requires. Then financial statement shall disclose all material items, that is if they can influence the decision of the users. This we have already discussed. For the purpose of this schedule, the terms used herein shall have the same meanings assigned to them in the Indian accounting standard. So if let us say there is a term called property, plant and equipment. So what is the meaning of property, plant and equipment as per Ind AS 16? You will follow the same definition. Where any act or regulation requires specific disclosures to be made in the standalone financial statement, the said disclosure shall be made in addition to those required under this schedule. So if there are additional disclosures required under a specific act, let us there is an act governing a particular company, and if there is an additional disclosure required, then in that case you will make that additional disclosure in addition to the financial statement of the company. For example, it's an NBFC. Now for NBFC you are following, we are preparing financial statement, but then RBI requires some more disclosures, so that will have to be given in addition. Now coming to the balance sheet part, which is the first part 1 of balance sheet. We have already seen it when we have practiced a lot of questions and all of that, but still a quick recap. Name of the company, so here you mention the name of the company, and balance sheet as at, let us say, 31st of March of a particular year. Now more important is the order, and for a lot of you who have followed the other schedule 3 for some companies, one significant change is assets appearing first and then the liabilities. Now as far as assets are concerned, first you have non-current assets. Under non-current assets, you have property, plant and equipment, capital work in progress, which is related to property, plant and equipment, investment property. So now if you see this, property, plant and equipment 16, investment property 40, goodwill will come from 103 and along with 38, other intangible assets 38, intangible assets under development again 38, biological assets other than bearer plants. See, bearer plants are anyways a part of your property, plant and equipment, so this is covered under 41. Financial assets, you have 109 and 32 and disclosures coming from 107, right. Then deferred tax asset coming from 12 and other non-current assets. So first you will have non-current asset with all this classification. For an examination purpose, whatever is the information in the question, only to that extent you need to reproduce. If some amounts are not given or not applicable, that you do not need to present. Then you have note number, very important for you to present the note numbers, and current period and previous period. In most of the cases in the examination, this information is not given, so you don't need to worry about that, right. So assets we have covered. Then coming to current assets, inventories in days 2, financial assets again 32, 109 and 7, right. And under financial assets you have investments, then you have trade receivables, cash and cash equivalents, bank balances other than those in mentioned in 3 here, that is maybe your deposits and all, then loans, others, then current tax asset, other current assets, right. Then this gives you the total assets. Then coming to the equity and liabilities side, you have equity share capital, this takes care of your share capital at face value, and other equity. So this will have your retained earnings, then you will have your securities premium account, then you will have your maybe capital redemption reserve, then you will have your other comprehensive income. Anything other than equity share capital is captured under other equity, a very very important component of the financial statement. Then coming to liabilities, non-current and current, again that classification. Financial liabilities again covered by financial instruments, then which has borrowing, lease liabilities, right? So that is a fresh addition, lease liabilities. Then trade payables to be segregated under total dues of micro enterprises and small enterprises, and total dues of creditors other than micro and small. So if the question gives you micro and small, okay, micro and small, not medium, micro and small, then that you will present it here, others you will present it here. So if the question tells you that to micro and small enterprises this is the amount outstanding, that you will present here, balance part you will present here. Then other financial liabilities, if there are any other financial liabilities, that you will present there. Then coming to provisions, so provisions governed by your 37, deferred tax liabilities. Please remember, deferred tax liabilities and deferred tax asset both are non-current, okay, so please make a note of it. Then other non-current liabilities. Under current liabilities, again financial, you are borrowing, lease liabilities, trade payables. Under trade payables, total outstanding dues of micro enterprises and small enterprises, total outstanding dues of creditors other than micro and small, again other financial liabilities, other current liabilities, provisions and current tax liabilities, that gives you the total of equity and liabilities, right. So that is one thing. Now another very important component is statement of changes in equity. Now what is this statement of changes in equity concern? This statement of changes in equity will give you what is the opening balance, what is the current period changes, and what is the closing balance. For what? For your equity share capital, for your retained earnings, for your other comprehensive income, for each of these items, for your securities premium, for your CRR, whatever belongs to the owner, what is the opening balance, what is the changes, and what is the closing balance. This is like your capital account in a statement format. So now here if you see for equity share capital, what is the balance at the beginning of the current reporting period, which is the opening balance, 1st of April, what is the balance, let us say year 1. Changes in equity share capital due to prior period errors. Was there any prior period error? That you show it here. Restated balance. So because you have changed it, this will give you the restated balance on 1st of April of year 1. Now if there are prior period errors which are retrospectively adjusted, the reason why we are giving this and this is because for users to compare, array last year financial statement it was 100, there are some changes here 10, now this has become 110. Now if I tell you it is 110 opening balance and previous year balance is 100, you will wonder where did that 10 come from. So for that purpose we have showed this separately. Then changes in equity share capital during the current year. So there could be issue, there could be rights, there could be bonus, there could be purchase, there could be buyback, anything, and balance at the end of the current reporting period. So basically in most of the cases you will have opening balance, changes and closing balance, right. Then for the previous reporting period, balance at the beginning of the previous reporting period, changes due to prior period errors, restated, changes during the previous year, and balance at the end of the previous reporting period. Then coming to other equity, a very very comprehensive disclosure requirement. Everything is not relevant for examination, but it is good to have a look at it. First one is share application money pending allotment. So here also, what is the balance at the beginning, what is the changes due to accounting policy or prior period errors, then what is the restated balance, then what is the total comprehensive income for the current year, from the P&L what is the balance that has come. Now this is not relevant for this. For share application money pending allotment, this particular thing is not relevant, okay. Then dividends is also not relevant, transfer to retained earnings is not relevant, any other changes and balance at the end of the period. So basically for share application money pending allotment, opening balance, the restated balance, what are the other changes and what is the ending balance, right. And mostly you will not get questions related to this. Then equity component of compound financial instrument. So under Ind AS 109 we have understood that if there is a compound financial instrument, a part of that is a financial liability, a part of that is equity. So now that equity component you will present it here, again here, what is the opening balance, what is the change due to accounting policy change or error, then what is the restated balance, then for the year income you will not have, again here also any other changes you will specify and balance at the end of the period. Then reserves and surplus. So capital reserve, securities premium, other reserves, retained earnings. So for these also, what is the opening balance, what is the restatement, right. Then what is the amount that has come from the comprehensive income, dividends, what is transferred to retained earnings. So what happens is Here, let us say there is general reserve and this is the retained earnings, which is the P&L balance. Now, from this P&L balance, you would have transferred something to general reserve. So, that you have to see, or from general reserve you have taken to P&L, that also you have to see, right. Then you have OCI balance of instruments, equity instruments through OCI and debt instruments through other comprehensive income. We have understood that. Financial liabilities, you can have amortized cost method, then you can have fair value through other comprehensive income, and you can have fair value through P&L. Now, when you say fair value through other comprehensive income, you are not classifying financial liability as equity, but this OCI balance you will have to present it separately. Okay, then if there is a cash flow hedge, what is the effective portion? Revaluation surplus, then exchange differences on translating the financial statement of foreign operation, any other item of OCI, for example, revaluation reserve, then money received against share capital. So, basically the breakup of any item which appears under other equity, you will say, and for examination purpose, what you need to keep in mind is what is the opening balance plus or minus changes and what is the closing balance. If you disclose this much, this is more than sufficient. Then similar disclosure you will do for previous reporting period also. Now that we have seen the format of the balance sheet, let's have a look at what is the general instruction for preparation of balance sheet. A lot of these concepts we have already discussed in the respective Ind AS. Okay, so I will not be going deeper into those concepts which we have already discussed, and also we have done the framework part. So there also we have discussed a lot of concepts around this. So what we'll do is we'll quickly skim through as to what are the things to be kept in mind when we prepare balance sheet as per your Ind AS format, right? The first one is, what is a current asset? So it says an entity shall classify a current asset when it expects to realize the asset or intends to sell or consume it in its normal operating cycle. So if something is to be realized in the normal operating cycle, then it is current. Or it holds the asset primarily for the purpose of trading. If something is for the purpose of trading, I bought the goods, I will sell the goods. So that is also current. It expects to realize the asset within 12 months after the reporting period. So this is the most important thing which you have to keep in mind. Something which will be realized within 12 months. That is before the end of the next financial year. If you are expecting to realize, then it is current. Okay. Most of the cases 12 months criteria will be met and it will be classified as current. But there may be asset where it may be beyond 12 months. For example, in real estate industries and all, where let us say your operating cycle itself is, let's say, 36 months. So what you have to keep in mind is something which can be realized within 12 months or operating cycle, then it is a current asset, otherwise it is a non-current asset. Okay. And if the asset is cash or cash equivalent, unless the asset is restricted from being exchanged or used to settle a liability for at least 12 months after the reporting period. So if it is a cash and cash equivalent, then also it is a current asset unless it is restricted. Say for example, I have deposited some amount in a bank and I cannot withdraw it for 5 years, then that is restricted cash and it is not a current asset, right? All other assets are non-current. Similarly, what is the operating cycle? It is the time between acquisition of assets for processing and the realization in cash or cash equivalents. When the entity's normal operating cycle is not clearly identifiable, it is assumed to be 12 months. So when you purchase an asset, let's say you purchase raw material, then you make finished goods, then you sell it to customers, you have debtors, then you get cash. So this duration is called operating cycle. Something which is consumed within the operating cycle is a current asset. If you cannot identify, then 12 months is the presumption. Similarly, when is a liability a current liability? If it expects to settle the liability in its normal operating cycle, it holds the liability primarily for the purpose of trading. This you can see in case of derivatives also. Then the liability is due to be settled within 12 months, or lastly, it does not have an unconditional right to defer the settlement of the liability for at least 12 months after the reporting period. So basically, in all these cases, what you are saying, if you settle it within 12 months or operating cycle, then it is current liability. Then we saw under financial assets something called as trade receivable. A receivable shall be classified as a trade receivable if it is in respect of the amount due on accounts of goods sold or services rendered in the normal course of business. So in the normal course of business, if I am selling goods or services, whatever is the amount due, that is classified as trade receivables. A payable shall be classified as a trade payable if it is in respect of the amount due on the accounts of goods purchased or services received in the normal course of business. So in the normal course of business, if I am selling, it's a trade receivable, the customer, and the supplier will be classified as a trade payable. So we have been using this term earlier. sundry debtors, sundry creditors. Now you will use the term trade receivable and trade payable. Then a company shall disclose the following in the notes. So you have to disclose some items in the notes. A lot of these are also given by the respective Ind AS, right? So let us have a look at it. In case of non-current asset, the first one, property, plant and equipment, you will give classification as land. So we will show land separately, then buildings separately, plant and equipment separately, furniture and fixtures, vehicles, office equipment, bearer plants and others. Asset under the lease shall be separately specified under each class of assets. So if let's say there is a lease of plant and equipment, where whatever assets are under leases, that you will classify separately. This we have seen in the schedules to the annual report that we have understood. Then a reconciliation of gross and net carrying amount of each of the class of asset at the beginning and at the end of the reporting period, showing additions, disposals, acquisition through business combinations, amount of change due to revaluation if it is 10% or more, in aggregate of the net carrying amount of each class of property, plant and equipment, and other adjustments and related depreciation, impairment losses, reversals shall be disclosed. So many things we have already seen. Opening balance, what is the cost, what is the depreciation, what are the additions, what are the deletions, if there is any revaluation, if there is any impairment, then changes in depreciation. All of these you will present it as a reconciliation. So basically in a statement format you will present this. For examination, you can just say, you will just be required to give gross less depreciation, what is the net amount, this is what you need to present. Then investment property, same, reconciliation of gross and net carrying amount of each class of property at the beginning and at the end of the reporting period, showing additions, disposals, acquisitions through business combination and other adjustment, and the related depreciation and impairment losses, reversals, etc. shall be disclosed separately. Sir, why no revaluation here? Because we cannot follow fair value for investment property under Ind AS 40, right? Then goodwill, again, gross and net carrying amount of goodwill at the beginning and at the end of the reporting period, additions, impairment, disposals and other adjustment. Please note, there is no amortization for goodwill. Under Ind AS, you do not amortize goodwill, so amortization is not given. Then any other intangible asset which are covered under 38, brand, computer software, mastheads and publishing titles, mining rights, copyright, patent, other intellectual property rights, services and operating rights. So any kind of right which you classify as intangible asset, that you will disclose. Other intangible assets, recipe, formulae, model, licenses, others. Again here, reconciliation of gross and net carrying amount of each class of asset, beginning and at the end, showing additions, disposals, acquisitions through business combination, revaluation change if it is 10% or more in aggregate of the net carrying value, and other adjustments including amortization, impairment losses and reversals. So all of that you will disclose separately. Then we have biological asset other than bearer plant. Bearer plant is covered under PPE. Other biological assets is covered under Ind AS 41. So here you will show reconciliation of carrying amounts of each class of asset at beginning and end of the reporting period, showing additions, disposals, acquisitions through business combination and other adjustments. Please remember, these assets we value at fair value less cost to sell, right? So whatever are the changes, that also you need to disclose. Then under investment, you will classify investment in equity shares, preference shares, government trust or securities, debentures, mutual funds, partnership, other investment. Under each classification, details shall be given of the names of the body corporates that are. So for example, there is investment in equity instrument of a company. That company is a subsidiary. So you will tell what is the name of the subsidiary, associate, joint venture or other structured entities in whom investments have been made and the nature and extent of investments so made in each body corporate, showing separately investments which are partly paid. Investment in partnership firm along with the name of the firm, their partners, total capital, share of each partner shall be disclosed separately, right? Again, nothing much for examination, but still these are the breakup that you need to. You will also disclose aggregate amount of quoted investment and market value. So what is the aggregate amount of quoted investment, what is the carrying amount, and what is the market value. Okay. So for example, these are listed entities in NSE. Okay, you have investments in equity shares, you have investment in shares of, let's say, Reliance, Asian Paints, Tata Motors and all of those companies. What is the carrying amount in the books and what is the market value? Aggregate amount of unquoted investment. If there are investments which are unquoted, what is the aggregate amount of that? And aggregate amount of impairment in value of. Then coming to trade receivables. Trade receivables shall be subclassified as trade receivables considered good, secured, if they are secured, considered good, unsecured, trade receivable which have significant increase in credit risk. So if there is an increase in credit risk, that you will disclose separately, and if they are credit impaired, there is a doubt that there could be a bad debt or something like that, that you have to disclose separately. Then allowance for bad and doubtful debt shall be disclosed under relevant head separately. Then debt due by directors, if directors have to pay, or other officers of the company, or any of them either severally or jointly, means individually or jointly with any other person, or debts due by firms or private companies respectively in which any director is a partner or a director or a member, should be separately stated. So slightly complicated, it is more like a related party disclosure. Okay. Debts due by directors. So if you have to receive something from the director, disclose. Other officers, disclose. Then any of them either severally or jointly with any other person. So director, officer. Okay. This you have to disclose. Then director or officer with another person. So if there is another person, that also you have to disclose. Then debts due by firms, private companies respectively in which any director is a partner, director or a member. So this director, if he is a director in a company, or if he is a partner in a firm, okay, or if he is a member in a company. So for these companies and firms and companies where the amount is due, that has to be disclosed separately. So for example, if I am a director in Indigolearn, I am also director in OneFin. OneFin has to pay some amount to Indigolearn. So that has to be disclosed separately, because I am a director in Indigolearn and also a director in OneFin, right? Then there is a detailed aging analysis which has to be given. This added recently, where you have to classify and show what is the aging analysis. This you learn in financial management also, right? Same thing here. So outstanding for the following periods from the due date of payment. So from the due date, if it is due for less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years total. So this has to be disclosed separately. In that, undisputed, considered good, undisputed, having significant increase in credit risk, then undisputed, credit impaired, disputed good, disputed credit risk, disputed credit impaired. Okay, so this you have to give an aging analysis. So what is the aging bucket? Less than 6 months, 6 to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years. 6 to 1 month, less than 6 months, 6 to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, right? So that is what you have to disclose. Then coming to loans, loans shall be classified as loans to related party, other loans. So if they are given to related parties or other loans. Then loans receivable, again considered good, secured, unsecured. Significant increase in credit risk and credit impaired. And then they will also be subclassified as secured, considered good, unsecured, considered good, and doubtful. Sir, what is the difference? So here you are saying consider good, what is secured? So you are saying good, secured, unsecured. Okay. Then you are saying increase in credit risk and credit impaired. Otherwise, other classification is secured, how much is good, unsecured, how much is good. So basically 2 ways of presentation, okay, and doubtful. Allowance for bad and doubtful debts should be disclosed under relevant heads. Again, same way we have with receivables, loans due by directors, other officers and all, those have to be disclosed separately. Then other financial assets like security deposit, bank deposit with more than 12 months maturity, others which you have to specify. And other non-current asset, you will classify under capital advances, advances other than capital advances, security deposit, related parties, other advances. Again, advances to director or other officers, other persons and all of that, again you have to disclose separately. Then under current assets, disclose inventories separately, and under inventories, breakup of raw material, WIP, finished goods, stock in trade, source, loose tools, others. This again is similar to what we learn in Ind AS 2. Goods in transit shall be disclosed under relevance of heads, and mode of valuation shall be stated. This generally we give it in the notes. Investments, again like we have for non-current investment, for current investment also you have a breakup that you have to do, same breakup. Then again trade receivable, again what is secured, what is unsecured, similar way what we have done for non-current, the same thing you have to do with current. One thing that sometimes students may have a doubt as to, sir, how can trade receivables be non-current? So what happens is, when we calculate the operating cycle, it is based on average. You don't say, for each customer I will calculate the operating cycle. It is done on the average basis. So let us say average operating cycle is 24 months, and to some customers I have given credit of 36 months. So the customer who has 36 months of credit, that will be a non-current customer, right, or non-current trade receivable. Similar to current, non-current, we also have in current for trade receivable, same analysis. Then cash and cash equivalents will be classified as balances with bank, of the nature cash and cash equivalents. So whatever you learn in the cash flow statement, in the same lines you have to classify here. Checks, drafts on hand, very less relevant as of today, because everything is NEFT and IMPS and UPI and all of that. Cash on hand, others. Then loans, again related parties, others separately. Receivable considered good, secured, unsecured, increasing credit risk, credit impaired, and similar thing. So whatever you have learned in non-current, same way is the breakup in the current asset. Then other financial asset. This is an all-inclusive heading which incorporate financial assets that do not fit into any other financial assets such as security deposit. So if something does not fit into any other financial asset category, that will be fit under other financial asset. Other current assets, advances other than capital advances, advances to directors, other officers in similar lines. Then earmarked balances with bank, for example unpaid dividends, you will show separately. Balances with the bank to the extent held as margin money against borrowings, guarantees and other commitments shown separately. So what happens is, when you have to take a loan or when you have to give a guarantee, you have to keep some amount restricted in the bank. So that will be shown separately. Repatriation restrictions, if any, will be separately stated. So that is with respect to other current assets. Now as far as your exams are concerned, these details, detailed disclosures and all would not be required. Once in a while, a question can come up in the examination where you must be able to explain how it should be disclosed. Okay, this is more from a practical approach when you have to go out and audit a client, or for example, you are working as a financial manager or a controller, right? For that, how the classification should happen, for that you need to refer to this. And a better way to understand this is to take an annual report of a listed company. Nothing can beat that knowledge that you would get from learning from a annual report. Now we are done with asset side. Let us move on to the equity and liability side. Let's move on to the equity and liability side. Under equity, we have equity share capital, right? All of us know it. Under that you have, for each class, so there can be different classes of equity share capital. For example, if you look at Tata Motors, under Tata Motors you have ordinary share capital, you have share capital with differential voting right. So if you have different class of equity share capital, for each class, what is the number and amount of shares authorized? What we typically call as authorized share capital. Number of shares issued, subscribed and fully paid. So out of authorized share capital, how much has been issued, how much have been subscribed and how much have been fully paid, and subscribed but not fully paid. Then par value of the share, this we also call it as the face value, sometimes also referred to as the nominal value. Then a reconciliation of the number of shares outstanding at the beginning and at the end of the period. What was the opening balance, any issues during the period, any shares which have been bought back, rights issue, bonus issue, closing balance. Then the rights, preferences and restrictions attaching to each class of shares, including restrictions on the distribution of dividends and the repayment of capital. Now for each class of shares, see, for ordinary shares there would not be any restriction, but for other classes of shares there may be some restrictions. For example, shares with differential voting rights, or in case of DVR for Tata Motors, they are entitled to higher dividend. Okay, all this must be disclosed. Then shares in respect of each class in the company held by its holding company or its ultimate holding company, including shares held by subsidiaries or associates of the holding company or the ultimate holding company in aggregate. Just to simplify this, if there are any holdings within the group, the holding, or the ultimate holding company or a subsidiary of the holding company, if there are any shares, that has to be disclosed. Then shares in the company held by each shareholder holding more than 5% shares, specifying the number of shares held. So if any shareholder holds more than 5%, that you have to disclose separately. Then shares reserved for issue under options and contracts for commitments for the sale of shares, disinvestment, including the terms and amounts. So if there are shares which are reserved for issues under options, you have given employee stock option plan, there are some shares which have been kept aside so that you can issue when the employees subscribe that, or if there are any contracts or commitments, any shares which have been reserved, that have to disclose separately. Then for the period of 5 years immediately preceding the date at which the balance sheet is prepared, so for 5 previous periods, aggregate number and class of shares allotted as fully paid up pursuant to contract without payment being received in cash. So if there are any issue of shares for consideration other than cash, that you have to disclose for how many years? 5 years. Then aggregate number and class of shares allotted as fully paid up by way of bonus, aggregate number and class of shares bought back. So shares issued for consideration other than cash, bonus issues and buyback of shares 5 years. Then terms of any securities convertible into equity shares issued along with the earliest date of conversion in descending order starting from the farthest such date. So what is the meaning of this? Terms of any securities convertible into equity shares, if you have issued convertible debentures. So the terms of the securities, that is the terms of the debenture which entitle them to equity shares, that has to be disclosed. In which order? In descending order starting from the farthest date. So you take the farthest date, let us say 2030, and in the descending order you have to show. Then calls unpaid, basically the calls in arrears, showing aggregate value of calls unpaid by directors and officers. Then forfeited shares, what is the amount originally paid up. So these are all the breakup. Then the shareholding of promoters has to be shown under promoter name, number of shares, percentage and percentage change during the period. Who is a promoter? Promoter here means promoter as defined in the Companies Act. Details shall be given separately for each class and percentage change shall be computed with respect to the number at the beginning, or if issued during the year for the first time, then with the respect of the or if issued during the year for the first time, then with respect to the date of issue. So you will say, okay, what is the percentage on 1st of April, compare that with 31st of March, what is the change that you will disclose here. Sir, we have issued the shares during the year, then from the date of issue till the end of the period, what is the change? Now this clause has been included, a lot of us do not pay attention. This is more to understand, are the promoters selling off their stake? And a lot of time what happens in many companies, promoters keep on selling stake and the retail shareholders like you and me, we keep on buying. Okay. So if promoter shareholding is going down, means there are two reasons. One, the promoters want money, they want to realize the profits that they have made, that is one thing. Or it could be that the company doesn't have a bright future. Okay. So you have to, this disclosure will ensure that the shareholders, if at all they read the annual report, they will get to know, is the shareholding pattern changing? Are the promoters going away and are new shareholders coming in? Then after equity share capital, you have other equity. So anything which belongs to the shareholders other than equity is disclosed here. What are they? Other reserves. Reserves meaning capital redemption reserve, CRR, right? This comes when you have redemption or buyback, that will be shown here. Then debenture redemption reserve, okay, which we also call as DRR. Then share options outstanding account, this we do in case of ESOP accounting. So we use other terms also, right? Share based payment reserve, so that also you can use it. Others, specify the nature and purpose of each reserve and the amount thereof. Additions and deductions since last balance sheet to be shown under each head. So generally this is presented as a table. Okay. Then retained earnings representing the surplus of the balance of the relevant column in the statement of changes in equity. So you have a statement called statement of changes in equity. There you have retained earnings balance. So that retained earnings will show under other equity. Then a reserve specifically represented by earmarked investment shall disclose the fact that it so represented. So for example, for this DRR, if you have debenture redemption investments, so that you have to disclose. Then debit balance of statement of P&L shall be shown as a negative figure under the head retained earnings. So if there is a debit balance, if there are accumulated losses, that you will reduce from the retained earnings, and it may be possible that this other equity number is totally in equity, that is also allowed. Then the balance of other equity after adjusting negative balance of retained earnings, if any, shall be shown under the head other equity, even if the resulting figure is negative. Okay. So even if the negative, even if the final result is negative, you will show it under other equity. Then under the subhead other equity, disclosure shall be made for the nature and amount of each item. So what is the nature, you will have to explain. Then moving on to liabilities, non-current liabilities, borrowings. Borrowing shall be classified as bonds or debentures. More we use in India as debentures term. Then term loan from banks, from other parties. Term loan means fixed tenure loan. Deferred payment liabilities, if you have deferred any payment, okay, which has to be non-current. Then deposits, loan from related parties, liability component of compound financial instrument. So as per Ind AS 109, in case of compound financial instrument, there will be equity and there is a liability component. The liability component is disclosed here. Others, other loans, please specify. Okay, so first one is borrowings. Then, so this is specifically with So this is specifically with borrowings. Borrowings shall further be subclassified as secured and unsecured. Nature of security shall be specified separately in each case. So what is the secured borrowing? What is the unsecured borrowing? Then where loans have been guaranteed by directors or others, the aggregate amount of such loans under each head shall be disclosed. So if the loans have been guaranteed by whom? Either by the directors or by any other party, that has to be disclosed. Then bonds or debentures along with rate of interest and particulars of redemption or conversion shall be stated in descending order of maturity. Again, you will take the descending order of maturity or conversion starting from the farthest redemption or conversion date. So take the farthest date, and from that, let's say 2030 and so on, you have to just order it in the reverse order. Where bonds and debentures are redeemable by installments, the date of maturity for the purpose must be reckoned as the date on which the first installment becomes due. So if there are installment redemption, if let's say one bond will be redeemed in installment, the first installment should be considered as the due date. Particulars of any redeemed bonds or debentures which the company has power to reissue shall be disclosed. Terms of payment of term loans and other loans shall be stated. Period and amount of default as on the balance sheet date in repayment of borrowings and interest shall be specified separately. So if there is any default, that you will have to specify separately, right? Then coming to provisions, non-current, you will classify them as provision for employee benefits, any other, then other non-current liabilities, you will plug the remaining items. Now, there is no need to learn these heads by heart, okay. Once you know the format and you know which item is presented where, that should be more than sufficient. A couple of reading of this schedule or a couple of reading of the annual report will help you understand what items are to be disclosed how, right. Then coming to current liabilities, again borrowings. In borrowings we have loan repayable on demand. So these are basically whenever there is a loan which is repayable on demand. If the other party demands, you have to repay. So these are not term, okay, from bank, from other parties, loan from related parties, deposits, others. Again, borrowing shall be subclassified as secured and unsecured. Nature of security shall be specified. Where there is a guarantee, that you have to disclose. Default you have to mention, and very important, current maturities of long-term borrowings shall be disclosed separately. So if there is a long-term borrowing for which we have a current maturity, okay, so there was a long-term borrowing earlier, now it falls due within 12 months, that you will have to disclose separately. Other financial liabilities like interest, unpaid dividends, application money received for allotment of securities to the extent refundable if you have to refund, unpaid mature deposits, unpaid mature debentures and interest, others. Long-term borrowing is a borrowing having a period of more than 12 months at the time of origination. That is the definition of long-term borrowing for the purpose of this. Then other current liabilities, revenue received in advance, you have received some advance money, other advances and others, and provisions for employee benefits and others. Then trade payables. Under trade payables, the following details relating to micro, small and medium enterprises shall be disclosed in the notes. So for the trade payables, micro, small and medium enterprises, you have to disclose them in the notes. So what are the disclosures? Principal amount and the interest due thereon to be shown separately, remaining unpaid to any supplier at the end of each accounting year. So MSME, you have to disclose what is the principal amount, what is the interest due thereon. Then amount of interest paid by the buyer in terms of section 16 of the MSME Act, along with the amount of the payment made to the supplier beyond the appointed day during each accounting year. So what is the amount of interest paid by the buyer? Buyer means the entity, in terms of section 16 of the MSME Act, along with the amount of the payment made to the supplier beyond the appointed day during each accounting year. So how much of interest have been paid and how much of money has been paid beyond the date, beyond the appointed date, that is the due date of the specific accounting year. The amount of interest due and payable for the period of delay in making payment which has been paid but beyond the appointed date during the year, but without adding the interest specified under the MSME Act. So basically these are the disclosures related to MSME, right, where you have to say, okay, how much is interest paid, how much is the delay in payment, considering the date specified in the MSME Act. Then the amount of interest accrued and remaining unpaid at the end of each accounting year, the amount of further interest remaining due and payable even in the succeeding years until such date when the interest dues above are actually paid to the small enterprise for the purpose of disallowance of a deductible expenditure under section 23 of MSME Act. See, so a lot of disclosures, basically it says Have you made any defaults in MSME? Have you delayed any payment for MSME? Is there any interest you have paid? Is there any interest which is payable? All of that you have to disclose. Then the aging of trade payable aging schedule, outstanding for the period from the due date of payment, less than 1 year, 1 to 2, 2 to 3, more than 3 years total. MSME, others, disputed for MSME, disputed to others. Then presentation of liabilities associated with group of assets classified as held for sale and non-current assets classified as held for sale shall be in accordance with the relevant Ind AS. So, if there are liabilities associated with group of assets classified as held for sale and maybe non-current assets classified as held for sale, you will present them as per the Ind AS. Then contingent liabilities and commitments, if you have not provided for or if you have not recognized, you have to show them. So, contingent liabilities shall be classified as various claims, classified as first, claims against the company not acknowledged as debt. Somebody has filed a case, somebody has demanded money, somebody says amount is payable. I have said I don't have to pay. I have not acknowledged it as a debt. So, this one is a contingent liability. Then guarantees is a contingent liability excluding financial guarantees. See, financial guarantees generally you will do fair valuation. So, that is a separate aspect. Then other money for which the company is contingently liable. Then if there are any commitments, please remember contingent liabilities and commitments. What are the commitments? Estimated amount of contracts remaining to be executed on capital account and not provided for. So, we have taken up some contracts, we have commitments. Let's say we are starting a plant, we have started constructing a plant, we have committed. Now, to the extent of WIP, we will provide. But beyond the WIP, which will incur in the future period, we have a commitment, but that is not a liability. So, we will not provide for that liability, that you will disclose here. The reason this is important is the readers of the financial statements, they must know, okay, for this company, what is the burden it is carrying. Then uncalled liability on shares and other investments partly paid. Now, this is from the point of view of the investor. If this entity has invested in another company, let us say, you have, let us say, Reliance Industries, they have invested in Reliance Jio. Currently, the called up is only 5 out of 10. Out of 10, only 5 has been called up. Remaining 5 will be paid when Reliance Jio calls up. So, this also becomes a commitment. Then, any other commitment provided. Then, amount of dividends proposed to be distributed to equity and preference shareholders for the period and related amount per share shall be disclosed separately. Arrears of fixed cumulative dividends or on irredeemable preference shares shall also be disclosed separately. Okay, so now sometimes it's inconsistent. You can't have irredeemable preference shares in India, right? But still, they have given that if there is any cumulative dividend on irredeemable preference share, they have to be disclosed separately. Then, where in respect of an issue of securities made for a specific purpose, the whole or part of amount has not been used for the specific purpose at the balance sheet date, there shall be indicated by way of note how much unutilized amount have been used or invested. So, let us say a company raises money for a specific purpose, amount is not yet utilized, that is what you have to disclose. And where the company has not used the borrowing from banks and financial institutions for the specific purpose for which it was taken at the balance sheet date, as on the balance sheet date, the company shall disclose the details of where they have been used. So, you have raised money, let us say by issuing shares, you have raised money by making some borrowings, but you have not utilized it for the specific purpose, you have to disclose them. Then, there are some additional regulatory information. 1. Title deeds of immovable properties not held in the name of the company. So, here this is more to do with the Benami transaction, if at all there are any. The company shall provide the details of all immovable properties other than properties where the company is the lessee and the lease agreements are duly executed in the favor of lessee as to whose title deeds are not held in the name of the company in the following format, where such immovable property is jointly held with others, details are required to be given to the extent of the company share. Now, what is the meaning of this? See, let us say the company has occupied a property. Okay, or the company says we own a property. Now, if it is a own property, you have the title in your own name, no problem. If it is a leased out property, the property is leased in your favor, you have executed a lease contract, no problem. But then I am saying this is my property, but title deeds are in somebody else's name, so that has to be disclosed. So, very carefully, the title deeds of immovable properties not held in the name of the company. The title deed is not in the name of the company, that you have to disclose. Okay. Now, these immovable properties can be your land, building, 3 categories, PPE as per 16, investment property as per 40 and retired from active use and held for disposal as per 105 or any other. Okay. What is the gross carrying value? Then title deeds held in the name of in whose name is the title deed held? Whether the title deed holder is a promoter, director or relative of the promoter, director or employee of the promoter, director, that you have to disclose. Property held since which date? Reason for not being held in the name of the company. Why are you not holding the title deeds in the name of the company, that you have to disclose. Then the company shall disclose as to whether the fair value of investment property as measured for the disclosure purpose in the financial statement is based on the valuation by a registered valuer as defined under rule 2 of the company's valuer and valuation rule. So if you remember, under Ind AS 40, you have to disclose the fair value of your investment property. Has that been done by a registered valuer? That is what you have to disclose here. Then where the company has revalued its PPE including ROU, the company shall disclose as to whether the revaluation is done by the registered valuer. Then where the company has revalued its intangible asset, the company shall disclose whether it has been done by a registered valuer. So basically they are saying, if you are presenting fair value, if you are revaluing assets, who has done it? Is it done by a registered valuer? Then the following disclosure shall be made where loans and advances in the nature of loans are granted to promoters, directors, KMPs and other related parties, either severally or jointly with any other person, that are repayable on demand or without specifying any terms or period of repayment. So if company has given loan without specifying the tenure or repayable on demand, then you have to disclose who is the borrower, promoters, directors, KMP, related parties, amount of loan which are outstanding, percentage to the total loans and advances in the nature of loan. So how much percentage of the total loans and advances are outstanding from these parties. Then CWIP, you will give an aging schedule as to how much is the amount in CWIP for the period of less than 1 year, 1 to 2, 2 to 3, more than 3 years. Project in progress, projects temporarily suspended. Then for CWIP whose completion is overdue or has exceeded its cost to its original plan, following CWIP completion schedule shall be given. So again an aging analysis. Now see, all these disclosures are more from the point of view of interest of the shareholders. The company would say, this is my CWIP. How do you know whether what is the status of the project? See, every shareholder cannot go and ask the company in the AGM, right? Okay, what is the status? Why have you not been able to complete? Why is there a cost overrun? So with these disclosures, the shareholders will be aware as to what is the status of CWIPs. Then for intangible assets under development, similar to CWIP for tangible assets, again give a aging schedule. Then details of Benami property, where any proceeding has been initiated or pending against the company for holding any Benami property under the Benami Transaction Act and rules made thereunder, the company shall disclose the following. So details of property. So now see, the first case was company saying my property, title deeds are with somebody else or title is in favor of somebody else. Now here we are saying company is holding title to a property owned by somebody else. So what is the property? What is the amount? Who are the beneficiaries? If property is in the books, the balance sheet the reference to the balance sheet. If the property is not in the books, then the fact shall be disclosed. Where there are proceeding against the company under this law as an abettor of the transaction or as a transferor, then details shall be provided. Nature of proceedings, status of the same and the company's view on the same. So basically, if there is a case against the company or if there is a proceeding against the company where the authorities are saying that the company is holding Benami property, you have to provide all these details. Where the company has borrowings from banks or financial institutions on the basis of security of current assets, it shall disclose the following. Whether quarterly returns or statement of current assets filed by the company with banks or financial institution are in agreement with the books of account. Now, this is a peculiar case where they are saying there is a borrowing from a bank. When you borrow money from the bank, what happens is the bank asks you to submit quarterly statement of inventory, debtors and all of that. A lot of companies, what they do is they randomly prepare some statement and they send it. Okay, you will also realize when you start working, they just somehow they will try to tally and then say, okay, this is the inventory, this is the debtor. Okay, and in some cases bank want invoice to invoice tagging. So for example, let us say there is an invoice number 1, 2, 3, 4, 6. Against this we have taken a loan of 10 crore. So we said we will purchase inventory. Against that inventory, this is the invoice number and this 10 crore is the loan taken. Now what we are supposed to do actually is, when we sell this inventory, we have to repay the money to the bank, but companies may not pay. So when preparing the statement, they will say this inventory is unsold, but the inventory actually may have been sold. So here the thing is, whether these are in agreement with the books of account. In the books you are saying inventory, that inventory is sold, but are you saying that for the bank the inventory is still in your possession? That you have to disclose. And if not, summary of reconciliation and reason of material discrepancies, if any, are to be adequately disclosed. Then willful defaulter, somebody who is not paying back the money willfully, okay, as per the RBI guidelines and all of that. Who is a willful defaulter? They have to disclose. So, where a company is declared as a willful defaulter by any bank or financial institution or other lender, following details shall be given. Date of declaration as willful defaulter, when he was made a willful defaulter. For example, in case of Vijay Mallya, they have said he is a willful defaulter, he doesn't want to pay. He has the money, he doesn't want to pay. That is a willful defaulter. Details of the default. Willful defaulter here means a person or an issuer who or which is categorized as a willful defaulter by any bank or financial institution or consortium thereof in accordance with the guidelines on willful defaulters by the RBI. Then any relationship with struck off companies. So, this entity is there, some other company is there whose name has been removed, struck off from the ROC. Now, if there is any relationship where the company has any transaction with companies struck off under section 248 of the Companies Act 2013 or 560 of the Companies Act 1956, the company shall disclose the following details: name of the struck company, nature of transaction, investment, receivable, payable, shares held, other outstanding, balance outstanding and relationship. Registration of charges or satisfaction with registrar of companies, where any charges or satisfaction yet to be registered with ROC beyond the statutory period, details and reasons thereof shall be disclosed. Compliance with number of layers of companies. So, there is a requirement which says you cannot have more than so many layers of subsidiaries, right. So, where the company has not complied with the number of layers prescribed under clause 87 of section 2 of the Act, read with company's restriction on number of layers rules, the name and CIN of the companies beyond the specified layers and the relationship or extent of holding of the company in such downstream companies shall be disclosed. Right? So, if they violate the number of layers, that fact has to be disclosed. So, now coming to layers of subsidiaries, you can have 2 layers of subsidiaries and one more wholly owned subsidiary. One wholly owned subsidiary will be excluded. So, there is 2 layers. One wholly owned subsidiary is excluded from this count. Okay. So, if you have more than 2 layers, let us say if you have 3 layers of subsidiary, then you are violating this particular rule and that has to be disclosed. Then there are some ratios to be disclosed: current ratio, debt equity, debt service coverage, return on equity, inventory turnover, trade receivable turnover, trade payable turnover, net capital turnover, net profit, return on capital employed, return on investment. All of these what you learn as a part of financial management, those ratios have to be disclosed. The Companies Act has not defined as to what is the method of calculating. So, you can use the generally accepted ratios and you can do the calculation. Then the company shall explain the items included in numerator and denominator for computing above ratio. Further explanation shall be provided for any change in the ratio by more than 25% as compared to preceding year. So, how have we computed, and if there is a variation, that has to be disclosed if it is more than 25%. Then compliance with approved schemes of arrangement. Where the scheme of arrangement has been approved by the competent authority in terms of section 230 to 237 of the Companies Act, the company shall disclose that the effect of such scheme of arrangement have been accounted for in the books of account of the company in accordance with the scheme and in accordance with the accounting standards, and any deviation shall be explained. So, if there is any scheme of arrangement, amalgamation, merger and all of that, you have to comply with the scheme of arrangement and you have to ensure that you also comply with the accounting standards. Then utilization of borrowed funds and share premium. Now, where the company has advanced or loaned or invested funds to any other person or entities, including foreign entities, intermediaries. So, basically there is this company, there is an intermediary, they have given the money or they have advanced the money to intermediary with the understanding, whether in writing or otherwise, that the intermediary shall, so this intermediary shall directly or indirectly lend or invest in other persons or entities identified in any manner whatsoever by or on behalf of the company. So, we have given money to the intermediary. This intermediary will invest in beneficiary. Okay. So, company has given money to an intermediary, the intermediary will invest in beneficiary. So, the understanding is that it will invest in a beneficiary or provide any guarantee, security or the like to or on behalf of the ultimate beneficiary, the company shall disclose. So, I have given money to someone, that other entity, that is the intermediary, will either invest in the ultimate beneficiary or provide guarantee on behalf of the ultimate beneficiary. What are to be disclosed? The disclosures are date and amount of fund advanced or loaned or invested in intermediaries with complete details of each intermediary. So, to each intermediary, how much amount have we given? Then, date and amount of the fund further advanced or loaned or invested by such intermediaries to other intermediaries or ultimate beneficiaries. So, I gave to an intermediary, let's say you gave it to the ultimate beneficiary, or you have given to another intermediary who will give it to the ultimate beneficiary. Date and amount of guarantee, security or like provided on behalf of the ultimate beneficiary, and declaration that relevant provisions of the Foreign Exchange Management Act, the Companies Act and the Prevention of Money Laundering Act, all of them have been complied with, they are not in violation. Where a company has received any fund from any person or any entities including foreign entities, the funding party, with the understanding that the company shall directly or indirectly lend, invest in other persons or entities identified in any manner by or on behalf of the funding party. So, this is the reverse scenario. The company has received the money, the company is the intermediary now, there is another funding party. So, there is a funding party, we are the intermediary and then we have the ultimate beneficiary, or provide any guarantee. Similar kind of disclosures are required here. Okay. Now, as far as this regulatory compliances are concerned, again I suggest a couple of readings would be sufficient. Don't waste too much of time in learning things by heart, but you must have a broad understanding. Okay, such kind of topics do exist. There is no point in learning these things by heart, especially from an examination point of view. Right. Then, where a company applies an accounting policy retrospectively or makes a restatement of items in the financial statements, or when it reclassifies items in the financial statement, the company shall attach to the balance sheet a balance sheet as at the beginning of the earliest comparative period presented. This we have learned as a part of our Ind AS as well, that you have to prepare an opening balance sheet in some specified cases, right? That is being re-emphasized here. Then, share application money pending allotment shall be classified into equity or liability in accordance with the relevant Ind AS. Share application money to the extent non-refundable shall be shown under equity, and to the extent refundable shall be shown under other financial liabilities. Then, preference shares including premium received on the issue shall be classified and presented as equity or liability in accordance with the relevant Ind AS. Again, the same thing. Compound financial instruments such as convertible debentures were split into equity and liability components as per the requirement of relevant Ind AS shall be classified and presented under relevant heads in equity and liabilities. Regulatory deferral account balances shall be presented in the balance sheet in accordance with the relevant Ind AS. Now, after having completed the balance sheet part, so more important from the exam point of view is the broad structure of the balance sheet and the notes related to the items presented in the balance sheet. Explanatory information, other notes, other regulatory information, you can just read it a couple of times and you can be done with it. Now, coming to the statement of P&L, name of the company for the period ended, so and so, revenue from operations, current period, previous period, other income, total income. So, revenue from operation as per Ind AS 115. Then, expenses, cost of material consumed, purchase of stock in trade. So, here cost of material consumed is your raw material, purchases of stock in trade, finished goods that you have purchased, changes in inventories of finished goods, stock in trade and work in progress. So, cost of material consumed RM you will get by opening stock plus purchases minus closing stock. Then total purchase of stock in trade and changes in inventory. Employee benefit expense as per Ind AS 19. Finance cost as per applicable standards, and maybe in Ind AS 109 would be there, 116 would be there, right, considering them. Depreciation and amortization considering 60, 40, 38 and also 116. Then other expenses, total expenses. Then profit or loss before exceptional items and tax. Please remember there is no extraordinary item. Then exceptional items, then profit or loss before tax. Okay, this should not be there. Then tax expense, current tax, deferred tax as per 12. Then profit or loss for the period from continuing operation, profit or loss from discontinued operation, tax expense of discontinued operation, profit or loss from discontinued operation after tax, then profit or loss for the period, then other comprehensive income. Items that will not be reclassified to P&L, so you have to disclose separately, income tax relating to these. So, if there are some items which will not be reclassified to P&L, for example, Ind AS 109, investment in equity, which has to be taken as a fair value through P&L, but we have classified them as fair value through other comprehensive income, that cannot be reclassified. Similarly, revaluation of property, plant and equipment, you cannot reclassify to P&L. All these you will show here. Then, other items which will be reclassified to P&L. So, if in the future it will be reclassified to P&L, for example, disposal of a foreign entity or foreign operation, that will be reclassified to P&L, right? Or there are FVTOCI investment, other other FVTO say investment, that will be reclassified to P&L. All of that you will present separately. Then total comprehensive income for the period comprising of profit or loss and other comprehensive income. So what we calculated here, profit or loss for the period plus other comprehensive income will give us total comprehensive income. Then earnings per equity share for continuing operation, earnings per equity share for discontinued operation, earnings per equity share for discontinued and continued operation, basic and diluted. Basically this is continuing, this is discontinued, this is total. Okay. Let's have a look at the general instructions. These are pretty simple, nothing complicated again. Statement of P&L shall include P&L for the period and other comprehensive income. 1 plus 2 is called the total comprehensive income. Then revenue from operations shall be disclosed separately in the notes as sale of products including excise duty. Excise duty is now applicable only on limited products. Okay. So sale of products and sale of services, and grant or donations received only in case of Section 8 company and other operating revenues. Then finance cost shall be classified as interest, dividend on redeemable preference shares. Now please remember, dividend on redeemable preference shares is a finance cost because redeemable preference share is a financial liability, and hence whatever you pay here will be your finance cost. Exchange difference is regarded as an adjustment to borrowing cost. So as far as exchange differences which are regarded as an adjustment to borrowing cost. So if there is an exchange difference and part of that we have considered to be a borrowing cost, that you have to disclose, and other borrowing cost. Then other income shall be classified as interest, dividend and other non-operating income, net of expenses directly attributable to such income. Then other comprehensive income shall be classified into items that will not be classified to P&L. For example, change in revaluation surplus, we have discussed this. This is covered by 16 and also 38. Remeasurement of the defined benefit plans, equity instruments through other comprehensive income, fair value changes relating to own credit risk of financial liabilities designated as fair value through P&L. So this we have understood that when there is a deterioration in the credit risk and because of which there is a gain, that has to be taken to OCI and that will not be reclassified to P&L. Share of other comprehensive income in associates and JV to the extent not to be classified. So if there is a associate or if there is a joint venture and whose share we are accounting for, and those OCI balance cannot be classified to P&L, so here also you will not classify to P&L. Share of OCI in associates and joint ventures, then any other. Okay. Then items that will be reclassified to P&L, exchange differences in translating the financial statement of foreign operation, debt instrument through OCI, the effective portion of gain or loss on hedging instrument in a cash flow hedge, share of OCI in associates and JVs to the extent classified into P&L and others. Additional information, a company shall disclose by way of notes additional information regarding aggregate expenditure and income on the following items. Employee benefit expense, what is the salary, contribution to PF, share based payment, staff welfare expenses. Then depreciation and amortization expense separately. This generally is a part of a schedule which has both your balance sheet requirement and P&L requirement. Any item of income or expenditure which exceeds 1% of the revenue from operations or 10 lakhs, whichever is higher, in addition to the consideration of materiality as specified in the clause 7 of general instruction of preparation of financial statements of a company. So any item which is either more than 1% or 10 lakhs, whichever is greater. Say for example, the turnover is 5 crores. Okay, 1% of this is how much? 5 lakhs. 5 lakhs or 10 lakhs, whichever is higher, it is 10 lakhs. So any item greater than 10 lakhs, you have to disclose separately. Apart from something which the entity believes it is material, apart from that, anything more than 10 lakhs, you have to disclose separately. If the, let us say, turnover is 100 crores, revenue from operation 100 crores. Now if it is more than, if it is 100 crores, then how much is 1%? 1 crore. So here anything greater than 1 crore you have to disclose separately. Then you have to separately show interest income, interest expense, dividend income, net gain or loss on sale of investment, foreign currency transaction and translation, payments to the auditor as auditor, taxation matters, company law matters, other services and reimbursement of expenses. In case of companies covered under section 135, CSR, amount of expenditure incurred on CSR and details of items of exceptional nature. Then undisclosed income, new amendment. The company shall give details of any transaction not recorded in the books of accounts that has been surrendered or disclosed as income during the year in the tax assessment under Income Tax Act, such as search or survey, unless there is immunity for disclosure under any scheme, and shall also state whether previously unrecorded income and related assets have been properly recorded in the books of account during the year. So, very unique kind of disclosure requirement. What this requirement is saying is, you have not disclosed something in your financial statements and you have not disclosed something for the tax purpose. Now, there is a search or a survey, and where there is an undisclosed income which you are now declaring or which you are now disclosing. So, for income tax you have disclosed. What have you done in the books? You should disclose here also. So, that is what you have to disclose. Then, CSR, where the company is covered under section 135, the following shall be disclosed. Amount required to be spent by the company, amount of expenditure incurred. We have a separate chapter for CSR, by the way. Shortfall, total of previous year shortfall, reason for shortfall, nature of activities, detail of related party transaction, and where a provision is made with respect to a liability incurred by entering into a contractual obligation, movement in the provision during the year shall be shown separately. Then, a very hot topic, cryptocurrency or virtual currency. Where the company has traded or invested in cryptocurrency or virtual currency during the year, like cryptocurrency like Bitcoin, you have Dogecoin, you have Ether, right? There are a lot of them. So, you have to disclose profit or loss on transaction involved in cryptocurrency, amount of currency held as at the reporting date, deposits or advances from any person for the purpose of trading or investing in cryptocurrency. See, now the hype around cryptocurrency has gone down significantly, but then still this has to be disclosed. Then changes in regulatory deferral account balances shall be presented in the statement of P&L in accordance with the relevant accounting standards. So, that is about the profit and loss statement for companies which need to comply with Ind AS. Again, I am repeating, for you, please ensure you know the format and you know what are the items to be presented under those specific heads. That is more than sufficient.